Good morning. I'd like to welcome everybody to the Audit and Finance Committee meeting for the CCIDA, CREDC, and CRC. We're at the BWB Building, 201 West 3rd Street, Jamestown, New York, and we're also streaming live on YouTube and Zoom. It's March 11th, 2026 at 11 a.m. Go ahead and start with roll call. Gary Henry's here. Dan Hetzenrader. Here. Megan Sheffield Smith.
Here.
And you should have already received the February 9th minutes and had a chance to review those. Do we have a motion to accept those minutes? Thank you. Second? I'll second. All in favor, say aye. Aye. The minutes have been unanimously approved. We'll move right into new business and discuss the audit of the 2025 financials. All yours.
Awesome. Well, thank you. In front of you is a draft copy of the audit. And I think this is always a really good opportunity to kind of walk through where things are currently. We've got a couple open items that we're still working through with Kayla and Shelby. But I think the meeting's the 24th, so it's nice that we've got a couple of weeks to, nail down any open items and loose ends before the board meeting. So what we'd like to do is kind of walk through some of the highlights and go through those. We also have our management letter and governance letter, which we can kind of walk through as well. So I'll kind of let Dana lead us off and we'll kind of tag team the presentation a little bit.
Okay. So if you want to start by turning open to page 1, you'll see our independent auditors report. Overall, no significant changes in the content between this year's report, last year's report. We're issuing an unmodified opinion, which is the highest level opinion you can receive. So it's a clean audit. So really when you set out to have an audit, this is kind of what you're aiming to achieve. So very nice job to Kayla and Shelby and the rest of your team in making that happen. So the next several pages 3 through 7, are management's discussion and analysis. I'm not going to go through this because we're going to cover a lot of it as we look at the actual face of the financial statement, but it discusses a lot of significant changes from last year to this year. It really just provides a clear picture of what happened with the numbers in the organization and in more of a narrative format. So if you haven't looked at it, I advise you to read through. There's a lot of good stuff in there. So if you want to turn to page 8, we've got our combined statement of net position. As you can see, the way that these are set up, we have, the 5 major funds of the IDA listed out separately here under the umbrella of CCIDA. There's a column over to the right for CREDC, which houses the operating fund and PEG. And then on the far right-hand column, we have the totals for the entire entity. So just to kind of talk through some of the, highlights here, you can see our cash balances. We have pretty healthy cash balances at the end of the year. In total, cash is up about 1.6 million from where we ended last year. Jumping down into the other assets section, you can see your notes receivable net of current portion. In total, out to the right, you can see we're at about 18 million at the end of the year, most of that coming from our LTEC fund and our EDA cares. Compared with last year, we're down about 1.2 million on that balance. We had new loans issued this year of about 1.2 million and then collections of around 2.6 million. Okay.
Really good year collection wise. I mean, it was, very few non-payments. I mean, it was like pretty incredible actually, when you look at it from a whole.
Yeah. So if you want to look at the line directly below that, we have our allowance for uncollectible notes receivable. In total, at the end of the year, we're about 4 million reserved. So no changes in the reserves this year from last year to this year. Currently, we're sitting around 21%. I think in the past, we've just right around 20. So we're a little bit more reserved this year than last year. And part of that is because of the drop in the receivable balance. We do our own calculation that's based on average receivable balance over the past 10 years, historical write-offs. And, when we're calculating it, we're coming to, closer to like 13-14%. So we're definitely on the conservative side. However, in talking with Shelby, we do have some, identified troubled loans. We have some that are in deferment. We have many that are on interest only. So the balance that we're showing here this year is probably reasonable.
Yeah, the tool, and we can provide it to Shelby and Kayla. It's pretty nice. It like looks at a 10-year history of everything that's occurred.
Mhm.
And then it kind of quantifies like what really are the write-offs over on average over that period of time. And I think, when you look at the LTEC fund, and I'm just trying to remember off the top of my head, we just looked at, I think it was like 13%, if I remember right.
Yeah.
And we're about 20%. But again, I think we've got a couple identified loans that feel pretty good about the 20. EDA cares, I think was closer to like 10%. And we're currently reserving closer to 20. So we're definitely conservative on the EDA.
Is there any downside to being more conservative? I mean, how does that affect us in a?
Yeah, I mean, I think
Where-
ultimately the number should reflect like where we think based on history and the current economics and, what we think potentially could happen. So it's a tough number to come up with because it's not like, you can't just base it on history because, I remember when EDA first came out,
Yeah, there was no history.
there was no history and we were in the pandemic and we're like, what should?
No, my question is.
Yeah.
Let's say you were not conservative enough and you exceeded that and you
Yeah.
had more loans written off than you had expected. How does that hurt your balance sheet? Or in the reverse, if you have a really conservative number too high and you come in less than that, how does that
Yeah.
affect the bottom line?
Good
Or
question.
is it more money that we could have lent out? But,
No.
I mean,
Yeah.
what's it?
It's more reflective of, at the end of the day, you have equity in those funds. And I think if in your first example, if you were not conservative enough and you had a lot of write-offs, then you can really say, what you were presenting as a receivable wasn't really a good number. And like your equity probably wasn't that because
What
you
you
were,
stated.
you were too aggressive on those reserves. Vice versa, if you were too conservative, probably your equity is a little bit higher than what you're ultimately reporting in the current year. For accounting purposes, you would rather be conservative than
Right.
the other way around.
I
And
agree.
I think, I think if you were at, that history showed you were at like 30% and you were only showing 20, like we'd probably be saying like, yeah, you need to bump that up.
Yeah.
Here, it's like, could you bump it down a little bit? Probably. I don't know about LTEC. I would probably say LTEC's good.
Yeah.
EDA, could we bring that down a little bit? Maybe, but I think based on discussions with Shelby, I mean, there's, we're in a dynamic time right now and
Sure.
things.
And I don't see any point in trying to make it
No,
look better, right? I mean,
Yeah.
if we were a private business, we were trying to sell or
Yeah.
something like that, then you'd want.
Yeah, there's no incentive.
Right.
Right, but for us, I mean, it doesn't, to try and make our balance sheet look better, it's better off to have a little extra reserve.
I agree.
And it's just a quick way to reference the risk.
Yeah.
Of collecting the
Mhm.
receivables.
Thank you.
So the last thing I wanted to highlight in that other assets section is the bottom of that, you'll see real property held for resale. That balance in total is up about 600,000. We had incurred costs related to industrial parks this year that got capitalized to this account here. And that was about 600,000.
So those were, engineering and kind of design that are really capital improvements on the land. And ultimately, your goal is to, sell that whole park shovel ready.
Mhm.
And so it's kind of quantified as an asset versus.
Yeah, certainly adding value to that
Exactly.
land.
Exactly.
So I'll add a little bit of color to what we've already provided for December compared to this, because those last two items are kind of the big variances from what I provided for draft December financials. So like they just spoke of, they pulled those professional fees out of the P&L essentially. So our P&L is going to look higher because we pulled those expenses out and put them on the balance sheet. And then the same thing with the the allowance for uncollectible notes receivable, we put a placeholder in there just in case there was an adjustment, and we did not make an adjustment. So basically, throughout the year, we collected, paid on principal, and didn't put anything to offset any more risk. So those are going to be the two big modifications from what we already provided for our December draft financials, which is what we expected too. So when I presented them, I called out those two items and expected those to change, so.
All right, moving down into your current liabilities. The one thing I wanted to highlight here, you'll see your unearned revenue, which makes up the majority of that section, that balance there. At the end of the year, we were about 4.4 million. Now, this is money that we've been given to spend on projects. Compared to last year, we're down about $500,000. Mostly, you know, in North County and broadband, as we continue to spend down those grants, we'll continue to recognize those revenues. So of that, looking more at the IDA portion, the 2.9 million, most of that's North County, which is about 2.2, I think.
That's the Ripley Industrial Park. They call it North County.
Yep.
And then, you know, 700,000 is the broadband, and then the last component of that is primarily South County.
Yep, and that's our contract with DFT, the 700. Yep.
That's it on the balance sheet.
Yeah, the only thing to add is over in credit, you'll notice there's a big unearned revenue as well of almost $5 million. And some of that is grants similar to,
Ralph Wilson.
yeah.
Mhm.
But a big part of it is actually your OCR grants that, you know, the money comes in, we pass it through to an entity, almost as like a deferred, like we put it as a receivable. And that receivable eventually may be forgiven.
Mhm.
Okay, and we've got two pretty substantial ones that
Brownfield.
are completed. Jamestown and,
Jamestown Advanced.
Yeah.
Oh, I'm sorry.
Yeah.
I was thinking, okay,
Yeah.
Brownfield would be in IDA.
okay,
kind of similar to that.
okay.
And so those really have been completed. We think they've met the terms and conditions, but New York State hasn't approved them. So for this year, we've kind of left them in receivable and also deferred. But once New York State does that official, yes, these funds can be forgiven, then basically the receivable go away and also deferred revenue.
Yep.
Yep. Okay.
Okay.
So that takes us to page 9. It's the income statement. So, you know, just kind of talking globally here, you know, revenues in total, we're actually very consistent with last year. There's a small decrease of about 25,000. Grant income was down. And then also if you were to compare last year, so we had a change in the CCIDA allocation, how that's reported. In the past, the costs were accumulated in the IDA, and then quarterly reflected, the costs were moved over to the individual funds through professional fees. And in the past, you would show a big component of revenue in the IDA to offset that transfer. This year, they started after Q1 reporting each of the wages and payroll, or the wages and benefits in the respective funds. So the impact here is the other income line is down because we don't have that transfer anymore. And then general administrative cost was impacted as well by that, also would have been decreased to offset. You know, looking at your bottom line in the IDA, as Shelby mentioned, you know, we're showing a $970,000 profit this year. And a lot of that comes down to the two things previously identified, the North County costs that, you know, we have revenue up there associated with that, but the costs that were expensed this year for the projects are capitalized on the balance sheet. So we're showing a big surplus there.
Yep.
Okay.
Yeah, so with those interagency charges at the end of the day, so the payroll was reported in the IDA, payroll and benefits, and then the IDA recorded revenue, and then each of the entities recorded intercompany charge. And so rather than having revenue and the intercompany charges, the revenue was removed, the intercompany charges were removed, And that payroll that was all on the IDA is now just allocated amongst each of the funds. So it didn't have any real impact on anything, but it just
Different way of doing it.
different way of reporting
Yeah,
it,
a
more or
little bit
less.
cleaner where,
It's more appropriate.
yeah, less eliminations
Yep.
essentially.
Exactly.
Okay. And then again, just kind of moving through, looking at the bottom lines here, you know, the revolving loan fund, small surplus this year, but almost breaking even. LTAC and EDA are both, you know, just under $300,000 in the bottom line. Brownfield, we're still kind of working through. We're still, you know, talking through that with Kayla and Shelby. So there could be some changes to come there.
I think there's a chance. So right now, there's a receivable for 156,000 and grant revenue of 156,000. I think when we look at the agreements, maybe that 156 will defer.
Yeah.
Potentially, almost treat it like an OCR grant.
Mhm.
So more to come on that, but that's maybe gonna get it modified a little bit.
Mhm.
And then CREDC right now, you can see we're showing a net loss right now of about 185,000, most of which has to do with the grant to PEG included in that for 100,000. So page 10, we've got our cash flow statement. I'm not going to spend a ton of time here. I mean, if you were to look at the last couple of years, you see that the net change in cash was cash going out because we were extending loans. Now that we're fully extended, we've moved into the collection phase. And so you'll see on the far right-hand column that we've got cash coming in of about 1.6 million, as I mentioned previously. Okay.
And again, that's our, you know, kind of approach going into Ripley, knowing that there's going to be a lot of expenses that we're gonna have to kind of pony up first and then get reimbursed.
Get
for. So
reimbursed.
that's kind of like the intent and why we're a little bit higher on cash this year.
Yes.
The next two pages are where we report the employee benefit plans that we offer to our employees. We've got the deferred compensation, our deferred defined contributions. Page 11 shows you where the plan assets were at the end of the year. Page 12 shows you the activity throughout the year. Okay. So the next several pages are the footnote disclosures. Just kind of highlight a couple of the more significant ones and the new items. You know, page 14, we've got a nice write-up here on your tax-based program. In total, our pilots were up this year to about 3.3 million in collections that were passed through. Page 16. There's a note here for other receivables, say related to our admin fees. There's another schedule later on in the notes where we break down the future payments that will be paid on an annual basis. Property and equipment, nothing really major to mention here. We had minor additions. So most of the change in that balance is just taking annual depreciation. 17, note 6 is, you know, the footnote that we have on unearned revenue. This is kind of a significant footnote. It spans the next page, 2 pages. You know, every significant component of unearned revenue is described here. And as we talked about previously, you know, it's a big number on your liabilities. There's a lot of work involved in understanding the activity and all the moving parts surrounding it. I'm sure Kayla spends a lot of time trying to.
A lot of work in getting the money too.
Yeah, sure.
So I'm not sure if unearned is really,
Yeah. Unearned, believe it. Yeah,
Unrecognized.
yeah, unrecognized.
So, yeah, there's a lot of work involved here, and actually I might be jumping ahead a little bit, but we do have a management letter comment that we'll talk about later, just about, that covers tracking of all of this. I think we have new software that we might be getting to.
Yeah, we recognize that because this is historically is what we did. I mean, in the last few years, we've really been hitting that hard. So
Financial.
you have to really come up with a different way of tracking it.
Yeah.
That's what she's been working on.
Yeah. Exactly. just real quick too, so we talked about the Ripley project and again, those professional fees capitalized as an asset. You had a significant amount of costs related to the broadband project.
Mhm.
And ultimately, we expense those because it was felt like there was really not gonna be a future benefit to us, like we're not gonna
No, there
sell.
isn't.
It's really just a benefit to the users,
Yep.
so it truly is a cost. And so there's a little bit of
Correct.
difference
Yeah.
between the two,
Yeah.
even though you would say they're both kind of related, but they're different on the recognition.
No doubt.
So jumping forward a couple pages, page 19. Another significant disclosure that we have here is this disclosure related to our notes receivable. Every loan outstanding that we have is described here. We include the payments, the interest, the maturity dates. Any new loans that were issued during the year are explicitly described there as well. Just a heads up, we do have one loan that we're still kind of talking with Phil and Shelby about. It sounds like there may be a new agreement for that we're gonna take a look at and see if there's any, if it's necessary to write down the balance or to reserve against it. Just a heads
Do
up.
you
on
just
it.
want to give a little bit of background just on that one?
Yeah, so we're talking about tube fab and I have to ask Rich for a little better documentation. But I talked to him last week when we first discussed this and he's like, yeah, that was kind of an email, some phone calls and basically tube fab hadn't paid in years and we were trying to get blood from a stone. So he worked out a deal where we would hold on to their balance. He gave them a revised amortization schedule for a lesser amount due. And if they satisfied that amount, which was like 200 and some thousand, if they satisfied that portion, then we agreed that we'd write off the remaining balance, which I think is a difference of like 300,000 or something. But I'll discuss with Rich and see if somewhere he has
Yeah.
better documentation.
It's not a surprise or anything, but it's just, it hasn't been formalized is what
Mhm.
we're trying to
Yeah,
Kind of
get so that we can adjust the actual financials. So that's where the holdup is.
but I mean, either we would be out around the 500 and some thousand, or we at least got 200 from them and called it a day after that. So that's kind of where his head was at with that. And I mean, that was quite a few years ago,
Mhm.
back in 2022. So
Mhm.
yeah, it's just following through on that documentation.
Thanks, Kelly. Yeah, there's a lot of activity. Again, I think if you were to last year's schedules and compare them to this year's schedules, like I think almost all balances went down. You know, which is again, it's amazing. Like really a good thing.
On page 23, I just wanted to mention under long term that we have this bond payable still on the books. That I think we've been in discussion with.
Yeah. So that'll be formalized, I believe, in March, because we'll bring that to the board. Get the full board approval in March and we'll remove it. So the county removed it from their books in December because it was approved on the county side in December, but we haven't fully approved it for our board.
Yeah, we need
Because we
to
missed-
do that.
Yeah. We missed the county voted, I believe, the day after our December meeting.
Yeah,
Yeah, and then
yeah, that one fell off my radar. We need to do that. Yeah.
I think I sent it to Millen, so I think it's on
Okay.
Millen's, it's on
Okay.
Millen's radar, but yeah.
Yep, that was
So it's just
that was
a-
the airport hangar.
Yeah.
Hangar A.
Jumping forward a couple pages, page 25. We added a write-up this year in Connect. Basically they're making their annual payments, but because they haven't broken ground yet, we have just the current year for the current portion. But the long-term portion is not yet recorded. if we were to, if they were to start construction in the upcoming year, that would be about a $1.5 million increase to your bottom line.
So just, and I know you haven't been on the board for a long time, Gwen, I think you remember, and Gary. But I think when we started doing these projects, initially we were getting, a big fee up front, and then ultimately I think it was like, let's try to build these over time, and then it'll bring us cash flow over, solid cash flow over a period of time. And so then the discussion was, well, what about revenue recognition? Like, when do we recognize this is revenue? Is it when we sign the agreement? Is it when we enter in the contract? Like, what should we do? I think ultimately, the board and management was like, well, until, shovels are in the ground, like, we should wait until that happens. And once that happens, then at that point, we can go ahead and record the whole amount, record as a receivable. And then it's just a matter of cash flow in the future. And so that's kind of the situation of the connection. We're not quite there, but
Yeah.
We thought it was important to at least show that, there is a substantial contract there. That could be a good thing going forward.
Okay. And then notes 19 and 20, I believe are already been updated. Make sure you read through those, and if there's any changes, let us know.
I think I worked on that.
Yeah, yep,
Yep.
I got them and I put them in here. I just want to make
Oh,
sure
okay.
that what you,
Yep.
yep,
I'll check it out.
all right.
Have we heard any updates from ConnectGen? Like,
Yeah, they check in with me.
I mean, are they actually gonna build it, or?
I think that they're kind of back to getting some proposals. I think that they had a big price change when what was that, in the fall, I believe, that I spoke with them. But it was more positive when I spoke with him in January. So I haven't heard from him in a couple months, but that's not atypical, so.
Wait and see.
Yeah,
Cautiously optimistic.
yes.
So that takes care of the footnote disclosures. There are several supplemental schedules in here. We've got the consolidating statements for CREDC, information on general administrative costs, and the tax exempt bonds are also nothing significant, I don't think, to note in those schedules. So I'm turning ahead to page 32, unless anyone has. So page 32, because we're considered a governmental entity, we have to have what's called a Yellow Book audit. So we issued this report for internal controls at the time. Ultimately, we didn't identify any instances that we thought were significant deficiencies, material weaknesses for controls. Okay, that's a clean report. Page 34. As we have funding specifically for IDA monies that we have to have a single audit, which is essentially a compliance audit over your major federal programs. And so we tested your EDA programs. Ultimately, in the subsequent pages, you'll see we didn't have any findings to note. Page 36 actually provides a nice summary of our audit results, and you can see unmodified opinions. And then what you want to see are X's in the right-hand column. It indicates no material weaknesses, no significant deficiencies. Really nothing to note. So that's it on the financial statement. Right.
Nice work.
Kudos to Dana for picking this up.
Yeah,
For sure.
yeah, no kidding.
I'm gonna start the meeting with that.
Yeah.
That you had a
Yeah.
brain on very quick. speed dial.
I have a consultant living under the same roof as me, very helpful. But yeah, it's a lot
Wow.
of work, a lot of stuff to take in, but You guys have been great to work with. You're very responsive to our requests and
When we're not sick.
so. So two more documents to cover real quick. I don't know.
I'm sure.
Mm,
Yeah.
Oh, yeah. There you go. But I need one more single guy.
One thing more.
We're good.
Okay.
all right, so I'm gonna.
I could get one,
You sure can.
too.
So I was gonna go over the 2-pager first, so the people document. So this is our governance letter.
We got two of these.
So this is a required communication from us as your audit firm to those charged with governance. So this would include you and the board. You know, it basically goes down to, it would disclose if there were any new accounting pronouncements that were implemented during the year. We didn't have any this year. Last year, remember, we had GASB 101 for compensated absences. Nothing like that this year. So you'll see that first couple paragraphs don't say anything like that. It also goes on to disclose any significant estimates, any significant disclosures, and that we feel the disclosures within the financial statements are neutral, consistent, and fair. On page 2, if we had any difficulties encountered in performing the audit or any disagreements with management, that would also be disclosed here. We don't have anything like that, so you'll see those paragraphs are also indicating that. You know, throughout the course of the audit, we're required to, you know, accumulate any uncorrected misstatements or corrected misstatements. In the past, we've had an audit difference because we haven't typically recorded accrued payroll. This year it was booked, so we, you know, felt it was good to remove that. So we don't have an audit difference disclosed this year. Okay. And then the last document that we have here is what we call our management letter. During the audit, if we identify any areas that we think there could be improvements made to your controls or your financial reporting, this is where we summarize them. So we do have a couple of items here. First one we kind of already touched on. This has to do with our tracking of our unearned revenues. So, and again, it sounds like we're tackling that in this upcoming year with the purchase of the new accounting software. So that, you know, should help out there. Second bullet point, bank reconciliations. You know, when we received the bank reconciliations, there was a small difference between what the bank recs were showing versus what was in our cash balances at the end of the year. It was minimal. However, you know, we're making the recommendation that any variances should be investigated and corrected as soon as possible.
And that's, you know, I think probably the new software might enhance it significantly because right now, you know, you have 2 bank accounts and many trial balances for each of your grant funds. And so it's a complicated system to do the reconciliation, where I think under the new software, you're probably just gonna have 2 trial balances and then the grants will be intertwined within the trial balances. So I think it's gonna make that process a lot smoother.
30,000 foot view, we'll have projects and we'll have grants that can crisscross between projects in the new system. Right now, we have projects that crisscross between funds, and we're kind of using funds for both grants and projects. And sometimes so it's a lot of journal entries. It's essentially what it boils down to is just the journal entries. But to Dave's point, once we get in Blackbaud, all of that's going to be housed like within the project or however that falls out. So that's going to be wiped out. That issue is going to be wiped out once we get into Blackbaud.
I mean, our current software is just not set up to do, it's ancient and it's not really set up to what we do now.
No,
Right.
With all these different funds and grants, and projects, and so that Blackbaud is gonna help us tremendously with that.
And then the last item here, this really is related to the grant that was transferred from CREDC to PEG. You know, I think it was included in the budget. The recommendation that we're making is also to realize that in the minutes as board approval resolution.
Yeah.
Mhm. Yeah. Yep,
That's a,
yep, we'll do resolution.
I mean, if, you could argue it's in your budget, everybody's aware of it, but you just think it, because it's a big amount,
Formalize it.
yeah, just to formalize it, probably
Yep.
makes sense.
And again, that just boils down to Ralph Wilson, and it was a match requirement, and just how we did the funding is what that was for.
That's everything I done going over today.
Nice work. Thank you.
Yeah.
Wonderful.
So a couple, things we're still working through and.
Yeah.
But, the goal would be to present, pretty much final form ready to go for the meeting on, I
Yeah.
think, the 24th.
And remember that from Dunkirk.
Yeah.
Don't come here.
I drove down here one day with Dunkirk meeting,
Uh-oh.
and luckily I was a couple hours early and that's like, Mark, what are you doing? I'm like, what?
It's like I work here.
What are you doing here?
Tell me it's not so.
Anything else to come before the committee meeting? Hearing none, we'll consider the meeting adjourned. Thank you.
Thank you.
Thank you both.
Yeah.
Thank you very much.
Nice work.